You know, Warren Buffett's annual letters to shareholders, they're legendary. They're not just some dry financial reports, they're basically a masterclass in business, investing, and even life, all packed with this incredible clarity and wit. So what we're going to do is distill some of his most timeless lessons, using his own words to try and understand how he achieved such extraordinary, long-term success.
Okay, let's just start with the number that honestly feels like a typo. 400,863%. That isn't a mistake. That's the overall gain in per-share book value for Berkshire Hathaway from 1964 all the way to 2007, which is the period we're diving into. I mean, that is an absolutely staggering figure. And to really wrap our heads around that number, let's put it in context. Over that exact same period, the S&P 500, which is, the benchmark for the whole market, it returned a very respectable 6,840%. But as you can see, it's not even close. The sheer scale of this just begs the question, right? How in the world did he do it?
Well, a huge part of the answer starts with just how he thinks about businesses. Buffett basically categorizes them into three buckets. You've got the great, the good, and the gruesome. And if you can understand this framework, you've got the first key to unlocking his entire investment philosophy.
And this quote right here, it really gets to the heart of his whole philosophy. He's just not interested in owning a mediocre business. Even if he can own the whole thing, he would much rather have a small piece of something that is truly, truly exceptional. This focus on quality, it's everything.
Okay, so what is a great business? What does one of these hope diamonds actually look like in the real world? For Buffett, the absolute prototype is See's Candy. Yeah, on the surface, it's just a chocolate company. But under the hood, the economics are what make it an absolute dream.
The numbers here really tell the whole story. Berkshire bought See's for $25 million. Since then, it has cranked out over $1.35 billion in earnings. But here's the kicker. It only needed $32 million in new capital to do all that. It's a cash machine that doesn't need constant expensive upgrades, which frees up all that cash to go out and buy other great businesses.
All right, next up, the good business. And honestly, this is where most companies fall. Buffett's example here is Flight Safety, a pilot training company. And make no mistake, it's an excellent company. It's got a strong competitive advantage.
But here is the key difference. See, for Flight Safety to grow, it needs a ton of capital. Since 1996, it has swallowed over $1.6 billion in capital expenditures. It's what he calls a put up more to earn more business. It's still a good investment, for sure, but it will never, ever produce that gusher of free cash that a great business like See's does.
And that, of course, brings us to the gruesome. Now, these are the businesses that, they look exciting on the surface. They grow fast, they attract tons of investment, but financially, they are just black holes. And Buffett's favorite example of this? The airline industry.
Look, Buffett does not mince words when it comes to airlines. This quote is classic Buffett. It's witty, it's memorable, and it is brutally honest. It just perfectly captures how he feels about the long-term economics of flying.
So what is it about airlines that makes them so gruesome in his eyes? Well, they grow fast, which always attracts investors. But that growth demands an absolutely insatiable amount of capital for new planes. And in the end, after all that spending, fierce competition means that over the long haul, they earn little to no money. It's just a bottomless pit for investor capital.
Okay, so if Buffett avoids the gruesome stuff, and he's just investing the cash from the great businesses, how did Berkshire get so massive? Well, he had a secret weapon, a financial engine that most people don't really understand, and it's all tied to his insurance businesses.
So what is this secret weapon? What powered so much of that incredible 400,000% return? Well, it's a really simple but incredibly powerful concept called insurance float. And Buffett, in his classic style, defines it so simply. See, insurance companies collect all our premiums up front, but they don't pay out claims until later, sometimes many, many years later. That giant pool of money they hold in the meantime, that's float. Now, it's not actually their money, right? But they get to hold it, and they get to invest it for their own benefit.
And just look at the growth of Berkshire's float. It's mind-blowing. From just $20 million in 1967 to over $35 billion by 2001. And this is where the magic happens. If Berkshire's insurers are disciplined and their premiums cover all their eventual claims and expenses, this massive pool of capital is basically an interest-free loan. But what if they achieve an underwriting profit? well, then they're actually being paid to hold on to billions of other people's money. This right here is the fuel for Berkshire's acquisition engine.
But you know, Buffett's wisdom isn't just about picking winners. It's also about being completely, radically transparent about his failures. He calls them his unforced errors, and he details them in his letters for everyone to see and learn from.
I mean, he is absolutely unflinching when it comes to critiquing himself. His purchase of the Dexter Shoe Company back in 1993 is a mistake he brings up again and again. At the time, he thought it had a durable competitive advantage, a moat that would protect it. He was wrong.
But the real lesson here, the one he hammers home, is about the true cost of that mistake. He didn't just lose the purchase price. Because he paid for the deal with Berkshire stock, he basically traded a piece of his hope diamond for a rhinestone. So the true cost wasn't the initial $433 million. It was the $3.5 billion that stock would have been worth by 2007. Just a devastating and powerful lesson in opportunity cost. And it's not just about the bad deals he made. He also talks about mistakes of omission, the things he didn't do. In his 2001 letter, written right after 9/11, he admitted that he knew a major terrorist event was a real financial risk, but he failed to actually prepare Berkshire's insurance operations for it. It's not enough to just see the storm coming, you have to build the ark.
Okay, so we've looked at his successes, we've looked at his failures. What are the big principles that tie this all together? It really boils down to a few timeless rules that have guided him for decades.
It really boils down to these 4 rules that have guided pretty much every decision. First, stick to a business you can understand. Simple. Second, look for those favorable long-term economics. That's how you find the greats and the goods and avoid the gruesome. Third, only work with people who are able and trustworthy. And fourth, don't overpay. It has to come at a sensible price. Sounds simple, right? But doing it consistently, year after year, that's the hard part.
And you know, if there's one single concept that really ties all of these ideas together, that underpins everything, it's what he calls the economic moat.
So what is that? An economic moat is basically a durable competitive advantage that protects a business from competitors, just like a real moat protects a castle. It could be something like being the absolute low-cost producer, like Geico, or it could be possessing a world-destroying brand, like Coca-Cola. This is what separates the hope diamonds from the rhinestones. Finding a business with a wide, sustainable moat is the key to the whole game.
And that kind of leaves us with a final thought to chew on. Once you start looking for this stuff, you start to see these economic moats everywhere. So the real question for you is, what business castles, protected by these deep, enduring moats, can you start to identify in the world around you?